been talking about Siam. It just wiped out about 10 years of any gains, and I bought back in. My average price is around 11 bucks, roughly where it is trading at now. So that's kind of my core position. I have a few others outside of that. I have some tech names, Illumina and A-Net, Arista Networks, and a few other very small plays, but that's kind of my core right now. Focusing on companies that I think will continue to be able to pay their dividends and whose prices will drop less than the market overall. Of course, I'm still holding my short position, so I am still biased that the market hasn't found a bottom yet. And that being said, for the first time in a long time, I thought it was the first time ever, but I think it has happened briefly before, we saw the 13-week, which I've been talking about, Treasury bill actually go negative. And right now it's sitting at negative .058. So, like, negative bonds kind of means an investor will receive less money back when the debt matures. So now you're investing into a bond, so you get $100, and then three years down the road you get $99 back. And people say, why would anybody do that? But if we go into a deflationary cycle, maybe that asset, even though it's going down, will perform better than another asset that will drop maybe 10% or 15%. The only alternative, of course, is to take all your cash and put it in a mattress, or buy gold or Bitcoin. And when we're talking of trillions of dollars, money has to go somewhere. So that's kind of what's happening with the negative yields. And it's also the actions of the Federal Reserve banks that are driving these negative, because at the end they're the net buyers, and in the short end they're the ones causing it to go negative. But this is upending a basic relationship that an investor should get rewarded for taking the risk, and and this has been a basic premise of investing for centuries. So today's Federal Reserve Bank, smarter than all of past history, I have my doubts. But and this all really started with Alan Greenspan back in 1998. Along with coordination with other banks, he bailed out long-term capital credit, which at the time was this kind of hot hedge fund that had these people, had two Nobel Prize winners on it, so kind of this elite group of intellectuals that were getting very good returns, but eventually they used too much leverage, got too much hubris, and eventually it collapsed. And Greenspan at the time was concerned because they had derivatives and stuff all around the world, causing a kind of a contagion in the financial assets. But at the time it was only about 4 or 5 billion, and I think the markets, it would have been good. It would have shook everybody up, and it would have put investors to be more cautious. Instead, it was bailed out. It was basically a non-issue, and from that time on, the market started to game the system by increasing leverage, knowing if things went bad, the Fed would bail them out, and they come up with these fancier and fancier derivatives and stuff, knowing that if things went bad, the Fed would be there to pick up the pieces. And that's exactly what happened in 2009. with Bernanke. They had the housing collapse where they came up with like collateralized mortgage obligations. That basically, I'm going to talk more about a new kind of entity similar to those in a minute. But you know, we saw them lower interest rates, we saw the TARP come in, and they basically just bought up all these assets. And mortgage-backed securities now are one of the biggest assets on the Fed's balance sheet. And basically they just bought those, printed cash, and then this bad assets sit on the Federal Reserve as an asset. And I'll show shortly the actual numbers on how much has gone to the onto the Fed's balance sheet. So yeah, basically, let me get that up so I can show. Move this over here. So we can see back in, before the financial crisis in 2009, this gray bar is actually the duration of the recession, but the Fed balance sheet was at that time about $800 million, and we can see it rapidly increased up to $2 trillion as they basically printed $1 trillion to buy all those mortgage-backed securities and bail out the whole financial sector and all the bankers. Of course, the people that were involved in this, nobody went to jail, which I really blame Obama for. He was meant to be the new hope for America, and they did absolutely nothing with Wall Street. And there was, to me, there was all kinds of crimes and misdemeanors that were never addressed. And we've seen here, to keep the economy going, then we had like the QE1, QE2, QE3, and it looked like around 2015-16 that things balanced off, and maybe now the market could actually kind of run on its own without the intervention of the Fed. But we saw here they tried to bring money back down on the balance sheet, and that was in 2018-19. And then we saw the market start to correct, which in December 2018, we had about that 10% correction. So the Fed reversed course, started printing money, and now we know it's all in for the Fed. The Fed is, before the Fed could only buy something like treasuries, the most pristine debt that was, backed by the government. And now we see they've started to buy corporate debt. Of course, they're still buying mortgage-backed securities, and now there's even talk of them buying stocks. So now we have basically the last 10 years has been socialism for the rich. They get bailed out if things go bad. Now we're seeing kind of socialism for everybody, that they'll just buy up any kind of debt there is. Of course, there's a limitation to that, and it goes against hundreds of years of economic theory. But right now we have no choice. I kind of agree with the stimulus package. People need some support to get through this crisis that we are right now. But we can see already, you won't see it here too clearly, but in a matter of a week or two, see how long these periods take just to do $1 trillion? Well, we did $1 trillion, the balance sheet went from about 4 to 5.2 in a matter of weeks. So printing that amount of money in a short period of time, we don't know what the impacts of that are. Are we going to end up with hyperinflation, or are we going to devalue the dollar? The dollar actually, ironically, has been strong, but you can only compare the dollar to other currencies around the world because everybody's doing the same thing. So that's where I actually reopened my Coinbase account I lost the authenticator for it, and I had to go through a process to get the account active again. And I'm considering maybe buying some Bitcoin if things continue to deteriorate, as it's just outside of the system. It's not a fiat currency, and also its value goes up as more people use it. Of course, the other thing outside of the system is gold, but I just don't see how gold is really functional in an economy. We're not all going to be, trading gold or whatever, but it is an asset class that has over hundreds of years, kept its value because there's actual work involved in mining it, right? So that's that. Get back here. So another thing that I was talking about, similar to, when talking about bonds, I don't invest in bonds, because I think the bond bubble actually might be worse than the equity. But bonds are related, of course, as I'll show, because most companies have a mixture of equity financing and bond financing. Something as an equity investor you look at very closely, because equity to a company never has to be paid back, or if there's a dividend, they can always cut the dividend, whereas bonds are different, right? They have to be paid back, and interest has to be paid, or the company goes insolvent. So I mentioned back in the housing, they came up with these financial assets, mortgage-backed securities, where they would basically slice and dice,